Hi, I'm Gwen Preston of Resource Maven. I'm here at the Metals Investor Forum in Vancouver in January, and I'm joined by Scott Melbye of Uranium Energy Corporation, a US-based energy or uranium getting ready to be producer, if you want to call it that. Scott's real expertise here is in the uranium market. He's been a uranium trader, consultant for his whole career, incredibly knowledgeable on that front. So that's what I'm going to take advantage of here, is to have that conversation. Uranium's been a really crazy space. I mean, since 2011 when we had the Fukushima disaster, obviously a lot of price weakness since then. Recently, we've been seeing some significant changes. We've seen McArthur River get suspended, and we've seen 2 production cuts from Kazakhstan, who's this sort of massive, low-cost, and had been growing producer in the sector. So put that into context for us. What does that mean for the uranium space?
Sure, well, Gwen, yeah, it's been a very eventful year. 2017 kind of ended with a bang in the uranium market. As everybody knows, we've been kind of suffering through a 7-year bear market where we had the strange situation where we've had 7 years of declining prices, but we've had production increasing globally.
Right.
And we knew that this wasn't sustainable at prices in the spot market at $20 a pound in that range. Very few producers globally can make money at that level. So the reason we hadn't seen more production cuts sooner in the market is really a function of uranium being an industry where there's a great deal of hedged contracts, long-term contracts with utilities at much higher prices than the current spot price. So producers have been largely insulated from the spot price decrease.
Right.
Having said that, those contracts were signed back in the 2007, 8, 9, 10 period are now falling off, and we're seeing very dramatic production cuts.
And I think another part of that, Kazakhstan has been a significant part of that production increase. So Kazakhstan's been really bringing this low-cost, in-situ recovery uranium online in a major way over the last few years. They're looking at IPOing their state-owned uranium company. You don't generally IPO into a weak market, and as someone with significant influence with the uranium space, yeah, they're incentivized to help strengthen the price.
Absolutely. It's been about 2 years now that the state-owned company Kazatomprom has been going through a transformation process to really transition the company from a state-owned model to one that's much more market-driven, and that all leads to the ultimate IPO that is scheduled for late in 2018. And part of that is realizing what their role is in the uranium market. The old Soviet model and post-Soviet model was produce more, not less. Right. And now they're realizing that it's in their interest to keep a lot of those valuable reserves in the ground and sell those into a better market down the road. So the 10% production cut at the beginning of 2017 was the beginning, and then a 20% cut of next 3 years planned production really adds to the equation, along with Cameco's cuts, production cutbacks in Niger and in Central West Africa, Namibia. So we're now seeing a situation where uranium production globally actually peaked in 2016 at 162 million pounds, fell to 151 million pounds last year, and now falling probably below 140 million in 2018. So that rebalancing of the uranium market is happening much more rapid pace than we saw even a year ago.
So now we're looking at a year when it looks like we're going to produce 140 million pounds. What kind of demand do we have? And I mean, demand is generally bullish, but talk a little bit about the demand side of the equation.
Well, the uranium consumption now runs about 189 million pounds. That's from existing reactors and those reactors that are coming online around the world. That compares down to 140 million pounds production. So we're developing quite a large gap. That allows the oversupplies that we've seen in recent years be drawn down much more quickly, and as I said, accelerating that market rebalancing. But the demand side does remain very strong. You see reactors really coming online in big numbers in India and China, the Emirates. We're seeing the Russian state-owned company building reactors in countries like Turkey and bidding in Saudi Arabia and other places. So the demand picture remains very strong. Production's now finally reacting to low prices, and the secondary supplies, while still significant, are being drawn down at a more rapid pace.
And then we haven't, it's not a conversation about uranium if we don't talk about Japan. When you talk about secondary supplies, Japan's a big reason for that. They have not been taking on uranium for a good number of years now since the Fukushima disaster. From what we understand, they're not really selling their stockpiles, but they're not buying, which is really significant because they were a big consumer. So yeah, let's just address the Japan question.
I think Japan, I think it's safe to say that 2017 was a year where Japan finally turned the corner, and it's been 7 years since Fukushima, so it has been quite a grind. But we did see Abe, the Prime Minister, win a convincing re-election, and his pro-business, pro-nuclear stance really assures this goal of 20 to 25% contribution of nuclear power. For utilities, they're now seeing units coming on. It might be at a slow pace, but they see there is a pathway to restart for reactors. We'll have probably 9 reactors operating by the middle of this year. And so that, certainly we're a ways yet from them coming back into the market and buying more uranium, but it's getting more and more unlikely that we see their inventories impact the market going forward.
And the question just diminishes too. 5 years ago, the only thing anybody talked about in the uranium space was Japan. Now that question's just being gradually answered, which is great. Okay, so production cuts, I mean, the numbers are quite significant. A supply deficit in terms of production versus consumption, stockpiles to match that up. Do you do a price forecast? Like, can I put you on the spot for any kind of concepts of when this might happen? Or what investors should watch for to know that this momentum is starting?
Yeah, well, it's a dangerous game to predict prices, but we definitely can say that given the level of production cuts that we've seen in the last 12 to 18 months, that recovery is definitely coming sooner than it was at that time.
Right.
So, we're in, prices are still in the low 20s. I don't think the fundamentals have really been tested by utilities yet. A lot of these cuts came at the end of the year going into the holiday season, and now utilities are coming back and reevaluating what this means for procurement. Do they advance long-term purchasing? Do they stay in the spot market? Either one of those choices, I think, will have positive pressure on both long-term and spot prices.
Right, and I've often said that what you should watch is for these new long-term contracts. Would you agree? When you start to see utilities signing new long-term contracts, that will really be the thing that says, okay, go time.
It is. That's probably the #1 catalyst to look for right now, is really that pace of long-term contracting. And the recent years, we've been at record low volumes of new long-term contracts signed worldwide. But at some point, the utilities have to come up for air, and that will have to reverse very quickly. And I think that's going to be the interplay for 2017 or 2018 going into 2019, is these utilities coming back and seeing a dramatically different supply side, where there's less oversupply and producers are not eager to lock in recent low prices any further into the future.
Now, I've taken advantage of your uranium expertise. I haven't given you a chance to talk about the company that you represent, which is UEC. So if we do a nutshell look at what UEC is in this game.
Yeah, I think going into 2018, we're excited about what's happening. I think in terms of all the things that we can control that are in our control, we're quite excited about. We've added to our resource base in Texas with drilling at Burke Hollow. Increasing pounds that are fully permitted, and in some cases under existing operations that can feed the Hobson plant. The restart on those can be quite fast, and obviously the cost of those, we realized that we could produce about $22 a pound uranium from an operation like Palangana, so that's quite competitive globally. I think we're going to wait until we see probably $40 uranium prices before that happens. But we continue to de-risk and develop South Texas. We've also been active now in the Powder River Basin of Wyoming with the Reno Creek acquisition, and then the subsequent Reno North acquisition, which was for us with really just about a 9% dilution in shares, doubled our permitted uranium with a 22 million pound addition to our resources in the Powder River Basin. We think those are the two best jurisdictions in the United States, and obviously strong ISR jurisdictions. So For us, it's it's 1 foot on the brake and 1 foot on the gas, but we feel that we're ready to capitalize on uranium price recovery and be able to get back in operation and start generating revenues and profits before too long.
Sure, and I know Amir, who's the CEO of your company, is unabashed in saying that he's driving UEC to be the dominant uranium producer in America, which is a really strategic uranium jurisdiction right now, when this market happens, and that's what UEC has been positioning for.
Absolutely. I mean, we vision ourselves within the next 4 to 5 years being a 4 to 5 million pound annual producer from these two jurisdictions. We think there's a new emphasis in the United States with the Trump administration to value domestic production and domestic energy security, and so we're seeing a lot of initiatives on that front to increase the current contribution from about 5% to something much greater than that, and we will certainly be there to contribute towards that sort of revival of U.S. uranium industry.
Absolutely. Thank you for your time.
Thanks, Gwen.